Good morning, Jags. This is Fahad. Today is Monday, June 15. What's up, gang? How's everyone doing?
Doing
Morning,
pretty
everyone.
good. How are you guys doing?
Doing good.
Doing well.
Yes, doing well. I spent my entire weekend by the swimming pool with a bunch of friends and family, so it was a nice warm day. Got a lot of tan, I guess.
It was
So
cooler this weekend up here anyway. It was
yeah,
more enjoyable than a very humid, sultry day.
I have a heated pool, so that doesn't bother me. And secondly, I would rather be in a 75-degree temperature outside than 90, 95. Then it gets too hot. So it was actually perfect for me. All right, let's take a look at the stocks tech market technically here. The S&P is going to gap down quite a bit, and we are taking out Friday's low here. All major indices are down. Dow is down about 600 points, Nasdaq down 118, S&P down 59, and Russell 2000 down 36. But here's the thing. On a percentage basis, when you look at this, Nasdaq is down 1.2% in pre-market, but Russell 2000 index is down 2.4%, so twice as much as Nasdaq. And you know what that tells me? That tells me that within the pre-market frame of trading, this the on a relative basis, the market is still gradually more and more positioning towards the growth stocks rather than the value stocks. So I expect a lot of the small and mid caps stocks to actually take a hit. Financial, transportation, industrials, as well as a lot of the restaurants and airlines, and all of those groups are going to be weak. But tech is where the relative outperformance will come from, and for Nasdaq to reverse an intraday decline of 100 points or something is nothing. So there's a good chance that Netflix may actually try to reverse this course while the rest of the market, particularly Russell 2000, will remain weak. So understand, sometimes you can just read into the pre-market trading, how the traders are positioning, and right now it looks like it's going to be continued position into growth sectors while value is still suffering. And now there's a very clear reason for this. um, there's been a lot of COVID has been is getting back in a lot of news frame every single day. So over the weekend we learned that Beijing is seeing a big breakout in COVID-19 cases starting from a large supermarket, so they started shutting down a lot of places there. There were 2 consecutive days of big spike in Beijing. Now remember, Beijing was shielded previously from Wuhan province, and that's because they had isolated pretty much Wuhan and quarantined everybody, with more than half the population tested there already, and nobody was allowed to come into Beijing. The highways were closed, the airports were closed, and everything. But since then, they opened everything, and now Beijing is becoming in the new ground where we're starting to see some spikes. So you have to monitor that. And then going over to India, India is seeing continued spike in cases. So this morning they're announcing that the entire city of Chennai, which is millions and millions of people, is going back into a lockdown until the end of June. So Chennai is a very populated area, and so that's coming from India. And then in the United States, you take a look at what's happening in Arizona, Texas, Florida, those 3 states, and that's where we're seeing continued spike and increase in hospitalization as well. People read these kind of news and they have to figure out, okay, so what does this mean for the market? And they go back to the same playbook that played out coming out of the March crash, which is more push into technologies that actually benefited from those trends, while money continuing to rotate out from those leisure and other places. So that's why you're seeing that significant amount of weakness in casinos has resurfaced. Win was gone all the way back to 107, 108, and now it's back to 80 something. I think 84 or 86 in pre-market, similar with Las Vegas Sands and such, and airlines have also fizzled and all of that. So it's just understand what is driving what. I mean, if you take a look at United Airlines, for example, United Airlines is currently burning $40 million per day of cash. $40 million per day. So despite all the capacity cuts, despite everything that's going on, the financial conditions for a lot of these airlines remain very, very troubled. and you could have reopenings with that much amount of burning of cash on a daily basis. This becomes a very difficult spot for all of them, especially if we're seeing spikes in key states. There are 14 states in the United States now where the hospitalizations are actually increasing, all related to COVID, with Texas, Arizona, and Florida on the rise particularly, but there are other pockets as well. So that's an impact on the entire travel industry, something to keep in mind. So that's the big picture view. Now, specifically, I want to just look at one stock this morning, which is Taiwan Semi. Taiwan Semi has been acting rather very resilient. I've gone in and out of this stock quite a few times, sometimes with call options, sometimes by just simply taking a common stock position. But I would have expected, with the kind of weakness that we saw in a major crash yesterday in last week in the market on Thursday, I would have expected Taiwan Semi to come in much more, but it did not. It immediately bounced back on Friday as well. Today, it's only going to be down about $1.50 looking at pre-market, so less than about 2%, 2.5%. And there has been no volume push behind this on the weakness, which means that the bulls continuing to hold the position rather strongly. This has a setup as it emerges out of this major VOP congestion level. If you look at all this VOP congestion between 54 and 50, it spent a lot of time over here and then emerged out of that, and now it's holding tightly in a rather weakening tape. So this has a setup that whenever this market pressure starts to subside, Taiwan Semi is likely going to push higher and make a run towards new 52-week high, basically taking out $60 and such. So technically, this looks like this is a very, very nice setup for me. I think this thing is going to push towards new 52-week high. And then fundamentally, I can tell you that last week, Taiwan Semi said that they were not taking down guidance for the year, despite the ban on shipping to Huawei. Now, in part, that's because the COVID has accelerated tech adoption, which might be offsetting the demand weakness overall in the smartphone category. Meanwhile, Nikkei reported, here is the article from that. Let me pull this up. Nikkei reported right over here that the chip design software maker Cadence System has seen an 80% increase in sales over the past 2 years in China, to about 13% of revenues, despite no longer selling to Huawei. So if we learn anything from Cadence Systems, CDNS, this stock has been on a strong trend. A name like this, despite significant amount of pushback for making any kind of sales to Huawei and then cutting out a lot of that business over the last 2 years of trade war with China, its sales in total in the last 2 years has increased by 80%. Now, bring this up because this could very well be the setup for Taiwan Semi as well as many other names that are exposed to China, because there's always this concern that the ones that have exposure to Huawei and HiSilicon and other Chinese companies, they're probably going to take a hit in the short term, but that did not happen with Cadence System. Cadence System revenues continue to move higher. Now, without significant evidence, that's perhaps the regional Chinese government research labs are picking up the slack as well, and that perhaps those might be affiliated in some way to Huawei. So in other words, Huawei could be taking a back seat, but there are a whole bunch of other buyers all over China as well that are continuing to buy the chips for IoT development and AI applications and such from Taiwan Semi. So Huawei is not exactly the gorilla in the room here at this time. And I would also speculate that, also without evidence, just to be clear, that perhaps those satellite research centers that are all over China are placing orders for chips on Huawei's behalf. So demonstrating how hard it can be to figure out who is in charge of what is in China. Last week, a company called ARM China, which is another article that I was reading, which comes down to this one right over here. Bloomberg reported this. ARM China is in serious violation of policies, only to have ARM China declare declared that they couldn't. It's unclear what's exactly going on, but there's a joint venture between SoftBank, SETA for puzzling and unexplained reasons why we are seeing suddenly sharp surge to sales to arms China, according to this Bloomberg article. So my point here is that Chinese sales are flowing. Huawei could be in the picture of maybe some sort of disruptions for a lot of these semi companies, including Taiwan Semi. But if you actually look at it as a whole, somehow they continue to actually make significant amount of sales to China. Maybe it's because relationships with SoftBank, maybe because a bunch of other research centers have come in and they continue to buy from Taiwan Semi and others. Nevertheless, if Cadence system is giving us any kind of idea, it is that China is still buying a lot of semis, and Huawei is not in the cards at all for these companies. So I'm watching Taiwan Semi. I like it technically. It is a name that has seen significant amount of call accumulation, and I think on weakness, I'm going to take another stab at it and look to get long call options with at least 3 months to horizon, which I think is going to carry the stock all the way back to new 52-week high. I don't think China is as big of a concern as people make out to be. So that's it from me on Taiwan Semi. Avo, you're broadly just looking at the market, see where we go from here, right?
Exactly. There's a lot of stocks that I think will pull back to the 50-day averages, which was for some of them it's a bit, others it's not. I wanted to add a little bit on your NASDAQ commentary. We also had the medical conference over the weekend, which is still continuing. There was the diabetes ADA convention. Well, it's electronic now, so e-convention, I guess. And
Yeah.
there was another one, well, escapes my way too early for me brain this morning. But there's a lot of conferences. There's a couple of conferences going on, and I do see that there are some companies that have gone higher pre-market. So that is also helping, along with some technology stocks. But I think some of the stocks that we talked about in the past couple of weeks, or at least that I had brought up, that were going higher on just sentiment, and even travel, as you mentioned as well, Fahad, and cruise industry, those will likely see a pullback. I really don't know how deep this will go. I would imagine we'd hit in 2850 at least in the S&P, something around that area. Just watching the NIMO and see how deep it gets over, not oversold, but how deep it goes into its numbers. We should hit the -60 in my opinion, but it's
Yeah, but
debatable. It depends on how much money comes in, if they start pouring money in this early or if they wait a little longer. I'm not sure, but at the very least, there's a lot of stocks that need to pull back because just based on technicals, they've just gone up too far.
I don't look at any single market internal indicator in a vacuum. I look a set of the picture, and then it tells me how the sentiment is overbought, oversold, and where things are moving. NIMO could very well get down to -60 today, with S&P going to be down more than 50 points at the open. But in itself, that's all that's telling me that on a very short-term basis, the oscillator is oversold. So you get another, minor day bounce, single one-day bounce, like the one that we saw on Friday after Thursday sell-off. The next thing you know, the selling could resume again. Because as a whole, if you look at all market internal pictures, we're working off such an extreme level of market conditions, market internals, that they all need to work off quite a bit just to get back to the neutral zone. We're not even talking about how much the CPCE equity put over call ratio and the percentage stocks trading above the 50-day and the NAAIM, the bull bear indicators, all of those, how much they need to actually come off. I will also caution one thing real quick, a bit on the darker side of things over here. I mentioned a lot of times now that the CBOE equity put over call ratio, the 10-day moving average of that, was a 16-year low last Wednesday before we had a Thursday market crash. And so keep that in the context that there's not a lot of hedging underneath the market. There's not a lot of put protection in place. And it's been because you've got all these Robinhood guys. You've got Dave Portnoy on Twitter, showing his account and people buying into a lot of the euphoria there. You've got all these gamblers from Las Vegas that have jumped in. You've seen amount of the Google search trends for call buying and day trading have basically skyrocketed. A lot of hot retail money has been chasing. You've got all these little obscure Chinese names that randomly spike 300, 500%, 1,000% in some cases. So my point here is that this is a June expiration week, this week. Understand that. And we're going into this week with tremendous amount of weakness in play at a time when people do not have a lot of hedges in play looking at the CBOE equity put over call ratio. This is where things could get wild, because once they start to pull the rug from the momentum names that have run up quite a bit without having sufficient hedges in play, weakness could be far bigger than one would assume. Pullbacks become dangerously crash mode. And that's what we saw example of that last Thursday. Understand that expiration weeks brings, and this is quadruple expiration week and not enough hedges in play. That's why VIX is responding the way it is. VIX is now at 41. The response to that major sell-off on Thursday, VIX went from 26 to 40 in a heartbeat. And that's why it responds so aggressively, because there's not enough sufficient hedging there.
Well, I use NIME as my primary indicator because it offers me the now type of, like, the quickest, I guess I can say, the quickest glimpse into the market sentiment. But
Yeah.
You're correct in saying that it should be looked at with other indicators in mind. How many are above the 50-day average, or all that stuff that we have talked about in the past. So it isn't just a sole indicator, but it is my primary one. I cannot deny.
Chronicle, what's up, buddy?
On the VIX, I'd just like to say that, when the VIX goes from 20s to 40s, volatility essentially doubles. So like $100,000 portfolio will start behaving like a $200,000 portfolio. So if anyone can't stomach violent equity swings, especially with their long-term retirement accounts, now would be a good spot to lighten up. But this is regarding one of the themes I plan to present in our upcoming quarterly outlook discussion, and it's to do with the FANG stocks. So after that short spell of value outperforming growth, it looks like these names are starting to outperform again. In pre-market this morning, NASDAQ looks like it's down less than the Russell. FANGs make up 40% of the NASDAQ. First off, I think these large tech names have been supported by relatively stronger balance sheets and higher profit margins, as well as relative earnings resilience despite ongoing issues in the economy. If we're looking at sell-side action, consensus has revised 2021 EPS estimates for the FANGs by just -5%, compared to -20% downward revision for the remainder of the S&P. And I've got some rough notes, but basically Amazon is currently my favorite out of all the FANGs. And I'll start with a process of elimination here. So if we start with Apple, none of the recent analyst checks for the company have been noteworthy. Like, for example, Wells Fargo on June 11th said that May smartphone registrations declined from the rebound seen in April. Meanwhile, KeyBank said in its checks that it showed iPhone sales have only improved quote unquote modestly, while online sales remained unchanged month over month in May. So basically, the only reason why sell side is still bullish is that the company's cash pile, 2021 5G story, and the hypothetical pent-up demand later this year. In other words, I think there are lots of better stocks to be long right now than Apple. Turning our attentions to Netflix, Jag subscribers are currently long Netflix calls right now, and we've been covering it extensively, so there's not much to add here. Next, moving on to Facebook and Google. I'm on the fence with these two. On the bright side, they will probably see a ramp in traffic as we near elections. And unlike ad revenue competitors like, say, New York Times or Fox, Facebook and Google are going to see engagement from both sides of the political spectrum as they are universal in terms of their audience. However, there are now increasing risks of a second round of shutdowns in several key states in the US, which is going to result in lower ad revenue if that happens. This is important because Google generated over 83% of its total revenues from the display of ads online in 2019, while 98.5% of Facebook's revenue is from ads. So getting long these two stocks right now is a bit of a gamble. Lastly, that leaves my favorite of the FANGs, which is Amazon. Unlike the rest, Amazon has minimal headwinds going forward and should continue to see sustained acceleration in earnings and revenue. On the revenue side, for example, RBC last week called the company a structural winner. It said that in its 8th annual US online shopping survey, it found that 64% of Amazon customers are making at least 2 to 3 purchases per month versus 54% in 2019. More importantly, Amazon Prime penetration has surged to 67% versus 59% last year, with numbers rapidly approaching 200 million. The key thing here is that Prime customers tend to be the most loyal users, both within Amazon as well as the broader e-commerce space. Separately, Wells Fargo cited eBay's recent upward guidance revision last week as evidence of strong digital commerce that should extend into the second half of 2020. Lastly, we also have to take into account the growth of the cloud market, which will enable AWS to continue its 40% CAGR trajectory. And Amazon Web Services, as we all know, is a high margin business. Like AWS revenues are only 15% of total revenues, but believe it or not, it makes up more than 3/4 of operating profits. So putting all this together, if we look at the ratio chart of Amazon to SPY, it's just been on a tear the last several years. So the takeaway here is simple. If you want to beat S&P in the long run, you can't go much wrong buying Amazon.
100% agree with you there on Amazon. It has been my favorite actually really since the start of the year, and that was well before COVID was in the highlights at all. My bull case long term was driven by what the company was doing with quantum computing, which doesn't even come into the picture yet because nobody's really paying attention to that. A big discussion happened for Amazon quantum computing in the first quarter outlook, and I think the company will continue to build upon that technology over time. But I agree with you. It benefits from higher cloud usage, it benefits from higher retail sales penetration in the e-commerce as an e-commerce category leader. It also benefits from just the general movement of flows into the big cap tech as they look for safety. And quite frankly, instead of just looking at the price as raw, if you actually look at it on a valuation business, trading at 4.5 times sales, growing 26% year over year, it's phenomenal. It's still a very, very powerful, very good story. I just want to quickly touch upon your Apple comment over there. Here's a chart that we shared with clients not too long ago. I just want to show you as you're thinking about the current second quarter fiscal year or current fiscal second quarter, which will be reporting earnings in a couple of weeks, in sometime in July. These are the trends that emerged as of the end of April. Now, I don't have May data on this chart yet, but you can just see that with the shutdowns and everything, the iPhone spend index completely crashed because the stores were all shut down, basically to zero. And many would have thought that the online component would have picked up the slack because you could easily go to the website and just order yourself an iPhone or any of that. Did not happen at all. And as a result, the total sales absolutely got crushed, in the month of February, March, and April. Naturally, there's going to be some bounce off of this level, but iPhone is 60% of the total revenues and operating margins. And if you look at the total or operating profits, and if you look at how deep the negative contraction was in iPhone's iPhone sales, and then you look at the chart, how far it has run. I think there are a lot of risks around this before the 5G comes out. Q2 will not be a good print. Q2 will be a scary print, in my view, when the company reports earnings. So, all right, with that said, Jay, what's up?
Hey, Vod, what's going on? So two names that I'm bringing today. Number one is Boston Beer. You just covered this last week in the June 11th webinar. Just wanted to mention that Goldman is raising their price target to 600 from 450 this morning. Now there's an image that I just shared. It is a long-term bullish note. Essentially, they're commenting on how the seltzer category will continue to dominate pretty much, reaching approximately 20 billion compared to the 3.5 billion today. So you just wanted to mention that really quick. And then
very interesting. This is the one that I've been waiting for a pullback to get long. It's just not giving me enough. I was hoping for under 500. Let's see if it'll give me one today.
Yeah. And then secondly, Dense by Sirona, XRAY is the ticker there.
Yeah.
Technically speaking, would like to see a move back down to around the $39 level near term. Now, HC Wainwright raising their target today to 50 from 38. Now, in that note, there's nothing that great. It's basically a note talking about reopening of clinics and whatnot. But last week, Stifel had a note out that I think went under the radar by pretty much everyone. Their note suggested that Wal-Mart has opened 3 dental clinics, all in the state of Georgia. And those clinics are basically offering your basic dental services, cleanings and fillings and whatnot. Now, Walmart had previously talked about pursuing dental services as part of their health initiative, but the way the clinics are outfitted was a bit of a surprise to Stifel, as they have higher end equipment, which includes Dentsply's CAD CAM scanning product, as well as their CBCT imaging product. So something to keep on your radar. These rollouts that Walmart's going to do, it's probably going to be slow and methodical, but could be a big positive for X-Ray.
Good stuff. It's also coming to an important support. Previously, it has been our big favorite before COVID happened. So I've actually always kept this one on my watch list, just because I believe the Prime Scan growth story is so strong and it's often overlooked. But now with stock decimated, if you start to see elective procedures start to come back, and now technically stock also pulling at a major support, with that Walmart news just providing icing on the cake, who knows, there might be a really good trade coming on this one pretty soon. So something we'll keep an eye on very closely. Good stuff. Here is the snapshot that you just sent me. So patient exams. So these are the pricings that they're charging based on what they're selling through Walmart, right? Okay, good stuff. Okay, we're going to stop over here. Thank you, everybody, for joining. I just want to say one last word about the S&P. Just when you look at SPY, just keep in mind your technical levels. This continues to be a major VOP support levels around 2295 to 300. Level in SPY. If we're going to break down through that today, there is a gap fill down to 286. That's a SPY I'm talking about. And so that gap fill could be coming pretty soon. And then let's see if there's an attempt there to bounce off. But just understand that we're really working off from what is extremely overbought conditions. So this thing has not run its course. It's going to spend a lot of time. And who knows, we could be falling into an environment where the market's going to remain in a chop fest mode all the way up until elections. I don't know how many people have actually thought through that scenario, where everybody is trying to identify a discernible trend, whether it's up or down. But maybe the pain trade here, something to keep in mind, maybe the pain trade here is nothing. Maybe the pain trade here is chop fast, because we overshot to the downside in March on COVID concerns, and then we overshot to the upside on massive liquidity injections, which the Federal Reserve has started to pull back. Now we're starting to fall in equilibrium ground where we have a case to be made that everything is back in line where the economy is. Plus, we have to start layering on top of it the picture that emerges if there is a change in outcome in election. So maybe the pain trade here is nothing but just lots more chop fest, a high volatility up and down all the way up until election time frame. Something to keep in mind, just throwing it out there. All right, that's it from me. I will see you in the chat room shortly.